Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. The S&P finished its first week of trading in August, having record highs and closing just 0.1% below that high point. Over the past 5 years, the index has returned 103%, and in the last decade, it has grown by almost 264%. Impressive as that sounds, it pales in comparison to the Nasdaq 100, which has rallied by an incredible 574% in the last 10 years. We experienced a period of unprecedented stock market performance, all the more extraordinary because of the events that the market has brushed aside during that period, which of course includes COVID-19. Stock market investors could be forgiven for thinking they are bulletproof if a pandemic and one of the greatest periods of economic turmoil the world has ever known couldn't knock them off course. But some traders on Wall Street are now starting to question what the threats to the market are and over what timescales they may come to bear. As we noted last week, it's possible to draw a direct correlation between the performance of the stock market and, in particular, technology stocks and asset purchases made by central banks, which have pumped trillions of dollars into the financial markets by buying bonds and other instruments to bolster confidence, increase liquidity, and encourage the reinvestment of sale proceeds. What investors must never lose sight of, however, is the fact that monetary policy and financial markets are cyclical. That is, they run in cycles and swing from peak to trough and back again. That process may take years, possibly even decades, but there's inevitability about the Federal Reserve and other central banks trying to normalize monetary policy, moving interest rates above zero, and putting QE back into the toolbox. For investors to think otherwise is tantamount to complacency. The move back towards normalized monetary policy will begin with a so-called tapering of asset purchases. Judging the timing of these changes won't be easy, however. Goldman Sachs recently suggested that the Federal Reserve will at least hint about tapering its $120 billion per month asset purchase program at its September meeting, and, in its opinion, will formally announce a taper at its December gathering. The investment bank points out that when former Fed Chair Ben Bernanke spoke about tapering in 2013, the S&P 500 fell by 5% over the next 5 days. Coincidentally, it's been over 6 months since the last U.S. blue chip index had such a move, which suggests it is long overdue for a meaningful correction. Tapering is not a threat to the market itself, but what is concerning is how investors react to the news when it comes. Another cause for concern comes from overseas in the shape of an ongoing crackdown by the Chinese authorities on the country's technology giants. That process started in October last year when Beijing derailed the much-anticipated multi-billion-dollar IPO of Ant Group, one of the largest financial services and payment platforms in China. The company and its high-profile founder, Jack Ma, were taken to task in no uncertain terms. More recently, Beijing has become more draconian. For example, it ordered the removal of ride-hailing app Didi from app stores in the country, just days after Didi had IPO'd in New York. Beijing also announced that Tencent would likely have to give up control of the music publishing rights that makes its Tencent Music service one of the most popular and profitable music streaming apps in the world. Beijing also announced that a slew of online educational services and apps that are incredibly popular across China could no longer be run as for-profit enterprises that charge for their services, effectively shutting down the sector. To an outsider, the Chinese government appears to be acting erratically where business is concerned. These might seem to be largely domestic events that are confined to China and therefore segregated from the wider markets. However, in an increasingly connected and globalized world, that's no longer the case. Foreign investors, including the world's largest venture capitalists, have invested billions into China's technology and startup scenes. The future for those investments is very uncertain now. And if those investors were to lose confidence in China, then that could prompt capital flight from the country and sharp sell-off in China and other emerging markets, which in turn could undermine wider investor confidence. Another potential risk to the markets comes from supply chain fragility and further interruptions created by COVID chaos in the worlds of transportation and logistics. Freight rates have soared and continue to rise. Meanwhile, a shortage of containers, truck drivers, and other key workers continue to cause bottlenecks. The latest cause for concern, however, is the rapid spread of the so-called Delta variant, even amongst countries and communities that have high levels of vaccination. There may not be such an immediate threat to life from Delta where workers have been vaccinated. However, the virus mutation seems to be more transmissible and therefore has the potential to spread quickly amongst workers in factory environments, making it hard to maintain production. Delta is an even bigger concern in those countries that don't have high rates of vaccination, but which are densely populated. And here there is a threat to life as well as the potential for further supply chain interruption. China is said to be restricting some internal and foreign travel, whilst Bangladesh is trying to ramp up its vaccination program, as only 2.5% of the country's 160 million people have been inoculated. None of these threats are sufficiently developed to derail the market tomorrow, but they are bubbling away in the background and could boil over in the near future. If and when they do, they are likely to catch many investors on the hop. After all, you only live once portfolios are not designed to weather a storm of any kind. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.